it's really up to the bank to have a strategy and a plan to enhance their transaction fee income. And there's a bunch of ways to do that, of course, but partnering with a technology company to bring in that transaction revenue is really an important part of that. And, I think the first step is for a bank to say, yeah, we want to increase our fee income. We want to get transaction revenue, and, hopefully transaction revenue can lead to some other types of revenue.
Welcome in, everybody. You're listening to Wrestling Payments, a podcast where we help payment professionals contend with the challenges of modernizing their payments operations and identifying ways to build for the future. If you're interested in payments innovation and modernization, you're in the right place. Now, let's get into it.
Welcome to another exciting episode of our special FinTech Shark Week series on wrestling payments. I'm Melissa Morgan, and today we're diving deep into the world of FinTech partnerships and the revenue opportunities that they present for financial institutions. In the episode, we're going to explore where the most realistic and immediate revenue opportunities lie when financial institutions look at these FinTech partnerships, and we'll discuss specific partnership models like possibly sponsor banking, acquiring embedded finance, offering new products, how these models can really help even drive deposit growth or just that fee income. We're also going to address kind of cost concerns. We have quite a few institutions coming back with a recent survey saying our primary hesitation, our primary concern is the cost of implementation, or really the hesitation is around how do we evaluate these upfront costs long term when we're relating it to any revenue opportunity we're trying to shoot for? How do we build that case for these partnerships that leadership can really get behind? So we'll explore a range of these opportunities throughout the episode today. And before we dive into the topics, I just want to introduce you all to the guests we have today. I'm thrilled to announce Niche's board member, Scott Goldthwaite. Scott has done extensive work with fintech and financial institutions, and we're really lucky to have him with us today as a guest. And I can personally say I've worked somewhat closely with him on a couple of projects, and Niche overall is just really lucky to have Scott on our board supporting our mission and really driving this industry forward. So Scott, welcome. Did you want to share a little bit about yourself and the work you're doing?
Yeah, sure. Thanks again. And thanks for having me on this wonderful podcast. I think it's great what Niche is doing. And I've seen, the 3 or 4 years that I've been on the board now, I've seen just such a huge change in how Niche engages with its banking members. And it's great to see the growth that's happening there too. So thanks for having me. And yeah, so it's a little background on me. I've been in payments for a little over 25 years now, all different parts, from issuing to acquiring to e-commerce to hardware to software and everything in between. I've had really a unique opportunity to work with banks, not just here in the US, but all over the world, implementing and rolling out really complex money movement systems. And I really enjoy that. I recently started my own consulting firm, FinTech Futures, and I'm working with fintechs and banks and helping put together all the pieces and helping that relationship work and finding the right partners in many cases.
So that's a great segue into kind of my first question for you. You kind of have to find what's right for you as a financial institution. A lot of the episodes I'm doing, there's hesitation for this reason, hesitation for that reason. And a lot of times it's because your asset size different, your market's different, the verticals you're going after are different. So this is kind of a loaded question, I think, for you, Scott. But when you look at these partnerships today for financial institutions from their perspective, where do you see the most realistic and kind of immediate revenue opportunities popping up?
Well, certainly let's look at it from the fintech perspective just for a moment, and then we'll switch around to the financial institution perspective. So for fintechs, without a bank, they're not in business. So I always say no bank, no business. So, and fintechs can have the most wonderful technology, the best ideas, the greatest people, but without a strong bank and a strong partnership, they can't even go to market. And then if you just look at all of the available banks out there, I mean, there's 4,000 plus banks, right, in the US, maybe more. There's only a couple dozen that really work with fintechs out of that whole opportunity list of banks. And that hasn't changed much. It's really the same banks doing the same types of things. And, I think there's a great opportunity for some other banks to get involved with this. FinTech's not new. What we call a payment processor 20 years ago is now called a FinTech. We called a third-party processor 20 years ago. That's called a FinTech now. What we call an ISV, now a FinTech. So, a FinTech is just the new name for companies that are providing really unique software and systems, in many cases, intellectual property, to solve a complex money movement problem. So not new, been around forever, just a new shiny name, FinTech, which is great. And that's what it is. It's a partnership between the bank and a technology company to bring an innovative solution to market.
And, you had touched on there's just a lot of financial institutions that aren't getting into the space. They just don't want to play in the space. I have to say, with the responses coming in, it's really just the uncertainty. It's not like we're not interested at all. Actually, that was an option as one of the answers on the survey. And it's one of the lowest responses on the, I want to say like 5% of responses came back with that. And a lot of these different models, they're just not sure what makes sense for them. So would you say there's a specific partnership model that you've seen that directly, especially when it comes to driving growth and fee income and things like that, and opening new doors to even new markets? Is there any models that you think would be directly related to that growth?
Well, I think let's start from the bank perspective now, right? On this particular question. It's really up to the bank to have a strategy and a plan to enhance their transaction fee income. And, there's a bunch of ways to do that, of course, but partnering with any technology company to bring in that transaction revenue is really an important part of that. And, I think the first step is for a bank to say, yeah, we want to increase our fee income. We want to get transaction revenue, and, hopefully transaction revenue can lead to some other types of revenue. And, when you look at the types of bank services that a FinTech needs, it's kind of all over the place depending on the FinTech, but there's definitely some commonality. FinTechs need to move money. They need to have FBO or DDA accounts or sub accounts or virtual accounts for money to come in, and they need rails for money to move out. They need a banking infrastructure to do that. FinTechs typically are looking for sponsorship on one side or the other. On the acquiring side, they're looking for sponsorship for payment processing, be that card or ACH or some of the new faster payments. Or on the issuing side, it could be, credit, debit, it could be any of the prepaid type programs. We're seeing now is that most FinTechs have a little bit of everything they need. They may have funding an account from a source, but then the destination is going to be a prepaid card for their employees. So the ability to work with a banking partner to understand both money coming in and money going out, and maybe not just break it into acquire or issuing, but look at what the entire solution needs to be. And I think a bank needs to say, yeah, well, I'm going to do kind of this part of the strategy and not that part of the strategy. And then, from there, you can then figure out what type of partners make the most sense to work with.
That's a great point. And you had mentioned, figuring out we go with this strategy and then we decide not to go with this strategy, or maybe could they phase it out, right? Well, we're going to start here and we're going to get, into this relationship, but almost plan a little bit for the future and how they can make these relationships kind of a little stickier, right? So you had mentioned, things are going to evolve. They're moving money in, they're moving money out. You have these embedded finance options, and how can you offer kind of a suite of services that complements everything and then makes you almost indispensable to their operations, right? Because you're providing all of this convenience and ease and things like that. Very, very interesting. So I did mention that, sir. Go ahead.
And where the partnership comes in to play is that on a scale of things, a FinTech is more indexed higher on technology and intellectual property and, market vision. And a bank's indexed a little more highly on KYC, BSA, compliance. But I think that's where the partnership is, right? A bank can't expect a FinTech to be experts in that. They expect some level of experience with it and to know it at least what the acronyms mean, right?
Yeah.
But in many cases, though, the fintech can't expect the bank to have some of the technology pieces that they may need. So what we see is, really kind of a web of banks and fintechs and third parties to come together to bring a solution into play.
And that's actually a really good point. So we could kind of talk a little bit about banks are the ones kind of operating under this traditional power structure, regulatory and risk, compliance, all of this that really does drive the cost of some of these relationships up. And having that reliance on your financial institution as a fintech to help you meet your obligations, because you only need to understand it to a certain level, right? Is there an opportunity even there to monetize some of this compliance you're doing on their behalf? Do you think?
Yeah, and there's always some opportunity there, because that's where a solution's going to work or not work. The technology on one side, but the regulations, the regulatory environment on the other, those have to be paired correctly for a fintech solution to work. You can search the internet for all of the fintechs that have gone bad because they weren't paying attention to some of these pieces. And the ability to really, for a fintech to speak the language of a bank is so important, because there's certain words that a fintech uses in their everyday that scare banks, even though it's just a different topic. So, being able to translate between a fintech and a bank is really important. And at the same time, a bank needs to bring up a new level of third-party due diligence. They need to really understand who their partners are, and even more importantly, who the partners' third parties are. So, what most banks probably have to have some type of third-party due diligence process. With a fintech, you really got to go to fourth party, because there's some off-the-shelf components that a fintech is not going to build, right? They may connect with an FIS or a Fiserv platform or a global TSYS platform for processing. They may connect to, a First Data type platform for card processing. So those are the fourth parties on top of the bank. So the bank really needs to understand the landscape of the third party, the fourth party, where the money is at any given time, who has custody of these funds at any given time, and what's the risk management of those funds at any given time.
Yeah, that's a great point. We're, just for the folks listening, if this is the first episode you're catching, the second in the series really dives deep into that intentional risk management framework around third-party relationships and those nested relationships outside of that, and putting those all through that same cycle. So really, really great point. And I think you kind of touched on this already, but we did have almost 60% of respondents saying, hey, we either, are concerned about costs, right? Either because the implementation cost is really high, we're putting our staff and resources into kind of monitoring, doing all the due diligence for onboarding, and then we have all of this ongoing monitoring, right? And we're really not sure of this long-term revenue potential. They're about 50% of those folks saying we're uncertain about the return on investment. So how do you think those financial institutions can kind of build a financial case for these partnerships to just get that backing from leadership and kind of step into the ring and play in the space?
Yeah, I was looking at some of that data too, and that kind of screams to me that we don't understand what the revenue potential is. So therefore, we're really focused on what the costs are. And yes, any new thing you're going to do is going to have some type of a cost to go with it, right? You may have to add to your BSA team or your KYC team. You may have to add some additional piece of software for monitoring. You may have to have new compliance people for oversight. You may need to have some biz dev people throughout and come up with the really good business solutions out there. So I think that if you can understand what the revenue opportunity is, based on what direction that the bank sees the strategy. A bank may say, okay, we really like this earned wage access program that's kind of new. We're going to work with certain companies that have the right licensing, but we know if we provide the infrastructure for accepting funds and dispersing funds, we know there's transaction fees here, and here, and we know that there's some minimums that we can put in place there. And, at some point at a level of transaction threshold, you can plot that break even point. So I think it's important for the bank as they're looking at their strategy is, okay, if we're going to drive new transaction revenue, I kind of know what my transaction costs are, but I know that if I'm going to bring on, a couple of program managers or a couple of fintechs, I need to add 300 or 400 people to do this. So, therefore the transaction revenue needs to be here for me to break even. I think it's a great exercise to do. I do it a lot. I help banks out with them a lot because some of these partnerships can be very lucrative. Even the RTP, ACH, those are transaction based, but you get into it with issuing, whether it's consumer, commercial, or small biz issuing, there's basis points to be made there, and that can be very lucrative for the sponsoring banks.
That I love that you just touched on faster payments, whether it be push to card, FedNow, or RTP. As part of that survey, responses came back like that is the highest use case most folks are interested in. But do you have any clear revenue generating use cases specific to the faster payment space that financial institutions who are interested in just getting into the space, don't just do it because everyone's doing it, right? But more so have this use case, lean into it with intent, right? Any like real life use case or case studies that you can share?
Yeah. So what's interesting about these newer, faster payments is that they, unlike ACH, which is kind of a broad usage now, right? What we are seeing out in the market for success with these faster payments initiatives is very vertical centric, and they are credit push, right? So it's a whole kind of different approach. So, what are those markets where credit push is valuable to have it now versus tomorrow or later on today? So certain verticals, whether that's, payroll, insurance, peer-to-peer payments, those are all verticals where you can make the case of, okay, if you want the funds tomorrow morning by 9 a.m., that's free because it's ACH. If you want it by the end of day today, that's going to be, $5 a transaction because that same day ACH. If you want it like right now, it's going to be $20 or something, right? So, and it's kind of like the FedEx model versus the post office model, right? People say no one ever paid for a package to get there immediately, but where we are. And real-time payment, regardless of the type of payment rail, there's some really good rails out there, and those are very use case dependent too. But someone's got to pay for them, whether that's the bank absorbs it at the cost, the fintechs absorb it at the cost that they mark it up, or the end customer that's receiving the payment is going to pay for it somewhere. And those that want money like right now, right this second, are really, yeah, I know. Sometimes better have it right now than wait for the end of the day, right? Hit the refresh button on your screen to see if the money hit it yet. But as we've seen real-time payments, open up the size of the transaction limits, it's going to really replace wires at some point. Even simple things like real estate transactions, down payments on your car, things you need to have money, good funds money cleared right then and right there. We're going to see those, and we'll start seeing larger dollar transactions. So I would say to some of the banks out there that, look at your current, book of business for commercial clients that you may have, and think about which of those vertical markets that where RTP can play a good part in. And I think that the converse of that is you also are receiving payments from your commercial customers. You can mine some of that ACH data to see where it's coming from, so get a good feel for what opportunities are out there too. So, sometimes your best source of market is right in your backyard, and being able to mine that data, whether it's consumer data or whether it's small commercial or large commercial data, some of those opportunities might be right there in front of you.
Right. I keep coming back to this it's really just exploring and seeing what makes most sense. And it sounds so much easier than it probably really is, but stay tapped in, stay tuned into different, groups, and making sure that, you're getting in at the right time, taking that first step that makes the most sense for your organization. And sometimes it's really just this like discovery phase, I keep saying, where you're just kind of seeing what's out there and what would make sense for you.
Yeah, and that's a good point, because it doesn't really cost anything to start looking, right? Other than time. But there's so many fantastic models that are out there now, from the small amount of sponsorships, banks that are actually doing real sponsorships. It's pretty small. That there's a lot of opportunity out there, and I think now is a good time, because 5 years ago, some of the banks had to really build out their own infrastructure to support fintechs. But now, there's some great partners with Niche. I think you've got Braid coming up later on. They've been on with Joe before, and they're probably coming up. Companies like Braid can get a small, mid-sized bank fintech ready in like no time. I saw Joe recently had Travis Delaney on there from Balance Trust the other day, or a couple weeks ago. Balance Trust can come into a small, mid-sized bank and get them compliant, or at least get the third and fourth party management part going. So at least you can assess your risk. So I think, because there's more components that a bank can pull off the shelf and plug in, one, it reduces the financial overhead, it reduces their risk, but also makes them more open to certain types of partnerships. So, I think a great place to start is with some of the Niche partners.
I agree. And as we continue to build that out, a lot of the third-party providers we have coming on to Niche as our newest members are really looking to be seen as people who care about meeting their obligations, who care about compliance considerations, and want to do their part in managing the risks related to what should be a really mutually beneficial relationship. So thanks for that plug. And our associate members, I agree with you on that 100%. One of the things that I also wanted to talk about, because I was a little, kind of surprised to see, cross-border payments are actually something that a lot of folks were responding to have some interest in. Do you have any realistic or ideas around realistic opportunities where you could even monetize those services, especially in light of, and I had mentioned this on a previous podcast, but what Stripe's doing, the recent announcement that they just put out, where, cross-border payments are going to be made so easy if you're powered by Stripe, right? So just exactly. Interesting.
Yeah, and Stripe can be friend or foe to a bank too, right? So
I know, yeah.
It's hard to say. And actually, the banks that are watching it, they should look at their ACH volume and see what's coming in from Stripe and Square and First Day, and then they can see that, right? Or going out to them too, right? Because they can pull out that ACH data. So what's interesting about your survey is, on the one hand, you have a group of people that are a little bit risk adverse, but it's like, okay, the heck with it. Let's just skip right to cross-border payments, which is the most.
That was interesting. I was like, wait a minute. Okay, guys.
Yeah, let's just go to the highest risk one straight away.
Yeah.
Highest risk meaning that, if you're moving money overseas, there's extra requirements for KYC and KYB, right, and regulatory, plus the FX model, foreign exchange model. So I guess if you want to jump right from kindergarten to, PhD, that's great. And I'm happy to help banks do that too.
Just want to do it the right way.
Exactly. And I think what we're seeing, and certainly cross-border payments, the peer-to-peer, moving money from people in the U.S. to people in other countries on the consumer side, that's been around for a while. Certainly, folks like Western Union and a bunch of others have had that market and the good side and the bad side of that market for many, many years. But what we are seeing definitely is, the global nature of business now, and what looks like even a bigger opening up of the global market for U.S. companies to be able to sell products overseas. The ability to pay gig workers remotely, the ability to receive funds from companies overseas. So, that type of cross-border payment related to B2B, it's wires right now, and it's a pain. So, there's a lot of companies that have been nibbling around the edges in supply chain management. Supply chain management often gets stuck up in supply chain financing, which doesn't end well. So if you just stick to one of those, like helping your commercial clients either make payments overseas in foreign currencies or accept payments from customers overseas in foreign currency, convert those to fiat, and then help your customers, help your clients grow in that. I think that's where the biggest market is. But like I haven't said, that's graduate level work. And when you think about some of the core systems that the banks may be using, they may not be ready for FX. They may not be ready for a lot of these things. But there's a lot of partnership potentials out there too. And I think finding that right partnership is important. I was recently at the annual Electronic Transaction Association, ETA, their conference was in last month.
Okay.
And stable coins were the talk of the town. And, we went through a phase of Bitcoin, and that scares a lot of people. And the reason why this is important is because stable coin, US denominated US dollar, digital US dollars, that may become the B2B cross-border currency of choice for a lot of customers around the world. One, it's a digital dollar, so you're not betting whether it goes up or down. It just is. But a stable coin has a lot more intelligence combined with it than just, a wire transfer. So again, going from zero, just stable coins and B2B FX, okay. I applaud that. But there are a couple of baby steps in between if you want to do that as well.
For sure. For sure. So, as you look ahead from the next 12 to 24 months, where do you see the biggest untapped or emerging revenue opportunities for these partnerships?
Well, that's a long time from now. So
I know, things move fast.
And when you think about, I mean, we can't have a podcast not talking about artificial intelligence, right? It's against.
I know. Yeah.
We're gonna have to talk about it, and practically, we're gonna have to talk about it. And so, a year ago, AI was kind of meh, and now it's built into everything. It's in my camera here right now, holding at me. So when I move out of the way, it keeps me in focus, which I like. But when you look at AI, where we are going to be, in a year and a half from now, agentic AI combined with stablecoin, combined with the ability to move money around the world, that's just an unbelievable opportunity.
Right.
What's great about agentic AI is that you can send your agent off to negotiate an agreement. My AI agent will talk to your AI agent, right? And then we can actually make an exchange using a stablecoin, but the stablecoin will be smart enough to release a certain amount of funds at a certain point of, a down payment, an inspection, and a receipt of goods. The agentic AI combined with stablecoins are going to make that process work while we're asleep. And, that's not that far off from now. So I think that for FIs, now is a good time to get involved in kind of the baby step parts so that you're just not blindsided when, a year and a half from now, when, everything is done while we're sleeping, that they're not blindsided by that.
Right. No, that's a great point. And I think that topic is a great one for another podcast. You could spin a whole bunch of podcasts off of that. So really good point.
I'll send my agent to the podcast then.
There you go. So any final thoughts from you, Scott, for the listeners today around how to kind of strategize to monetize these relationships and kind of get in the game?
Well, a great way to wrap up. So I think the first step is for an FI to really take this opportunity to think about how you're going to grow your fee income revenue with transactions, whether that's issuing, whether that's acquiring, whether that's sponsorship for ACH or R2P or any of the faster payments, even something simple as sponsoring the old RPPS system from MasterCard. There's still a lot of dollars that run through that thing. I think that's the first step is, okay, what do we want to be when we grow up in this AI powered financial services world? Do we want to be a player in it? What parts do we want to play? What do we don't want to play? And, how do I pick the right partners. And, I think one of the first steps there is to really talk with the folks at Niche, because, Niche is sitting in the middle of this with great partners, a great understanding of risk management, trusted partner for all the banks and members. And, as Niche's base starts to grow with a lot of different companies out there, that should give some comfort to BFIs to partner. And, I think when in doubt, ask for help. And, Niche is always there to answer. There's always someone there to point you in the right direction. And I think getting that strategy together is great. Finding the right partners is great. And then dip your toe in and see what happens.
Well, thank you for that. I echo what Scott says, not just because I love Niche, I work for Niche, but we really are your unbiased strategic partner in payments. And we are continuing to grow. We are continuing to meet new fintechs, third-party service providers, financial institutions whose voices we'd love to just bring into the community so you guys can all connect and hopefully build something great together. So thanks everybody for joining us for this episode. I hope you found our discussion insightful and engaging. We do have a couple other final episodes coming up where we're going to continue to explore not just exciting topics, but how one bank became the largest growing bank in their state, and another is recognizing revenue from the second they've onboarded one of these relationships. And it's not just a drop in the bucket. So we hope that
Can we add in one more thing too?
Yeah, sure, go for it.
Well, don't forget to come to the Niche Payment Conference coming up. Niche, I'll be there. A lot of other Niche partners will be there. So just to keep the conversation going or even getting started, make sure you come to the conference.
Thanks, Scott. And not just if you can't make PMC next week, our payments management conference, we do have the Future of Payments Symposium taking place this fall, where these conversations are going to lead the content, the strategy, and the discussion. So thanks again for tuning in. So until then, take care, keep listening in, and keep exploring what possibilities are out there for you. Take care, everybody.
Thanks.
On behalf of Niche, your trusted resource in payments, and our guests, I'd like to thank everyone for tuning into the podcast. If you've enjoyed this episode and want to hear more about payments innovation and modernization, you can find the Wrestling Payments Podcast on the podcast page of niche.org or wherever you subscribe to podcasts. Just search for Wrestling Payments in your podcast app. Thanks for listening.